Welcome to Yahoo Finance's special coverage of the November jobs report. I'm Julie Hyman. Of course, we're just moments away from the payrolls print. Joining me to preview the results, a very brief preview, is Joe Brusuelas, RSM chief economist. Thanks so much for being here, Joe. So the consensus estimate here for November is for 50,000 jobs to have been added to the U.S. economy and the unemployment rate to have ticked up to 4.5%. But as you know, this is a tricky report because we are getting partial results for October.
Well, that's right. And in the October report itself, it's widely thought that the DOGE layoffs are going to show up, and that will be perhaps the source of a negative print. So the degree of difficulty in this one is enormous.
Yeah, most definitely. And, we're still trying to get our arms around this sort of low hire, low fire environment and exactly how that is going to play out in these numbers. And I remember you saying when the government shutdown was happening that the numbers might not be clean or higher quality even until January.
And that's definitely the case here. When we get the November numbers, everybody should assume that there's a pretty big margin of error here and don't take them as gospel, meaning you're likely to see some revisions, perhaps even to the downside again. And often when you get late in the business cycle, the first estimates are then followed by downward revisions. And it's beginning to look a little bit like that. In fact, today I wouldn't be surprised if there's a big downward revision to the September estimate. So what I'm looking at is the total increase in employment over the 3 months once we get revisions accounted for today.
Okay, so that's a good tip to keep in mind. And because of that, we could see some more volatility in the markets. That's something we'll be watching for as a result of that. In addition to that, we've sort of gotten back into this a little bit of a good news is bad news environment. So if you do get a number that misses, if that raises the market's estimation of how many rate cuts we're going to get next year, maybe you could see a positive reaction in equities. We're starting to get the numbers now. 64,000 is the November number. The U.S. economy adding 64,000 jobs in November. That is above the 50,000 that was estimated. However, the unemployment rate ticking 2 ticks higher to 4.6%. That is a little bit worse than had been estimated here. Looking at some of the other numbers, we've got average hourly earnings rising considerably less than estimated, 0.1% on a month-over-month basis. The labor force participation rate at 62.5%. So those are the numbers writ large here. October non-farm payrolls falling 105,000. That is a much steeper drop than had been estimated here. So all of these numbers on balance are mixed, I guess is what you would say when all is said and done. And as I was just talking about with Joe a few moments ago, this is indeed a noisy number. So just summarizing here again, 64,000, the addition of jobs in November to non-farm payrolls. At the same time, the unemployment rate going 0.2% higher to 4.6% from where it was on the last read, the last time that we got a jobs report, and average hourly earnings rising only 0.1% on a month-over-month basis, although I guess month-over-month is kind of tricky here, 3.5%, let's call it, on a year-over-year basis, and October payrolls falling by 105,000. I'm still going to be looking for these revisions here that we were just talking about with Joe that we could potentially have because of maybe an overall worsening labor market here. So that's something I'm just going to look here. The change for August revised down by 22,000. That means the total job losses in August, were 26,000. For September, we saw a revision downward of 11,000. So still saw a gain of 108,000 in the month of September. So noisy indeed, but seeming to again show this overall slowdown. We were just looking at futures here and because these numbers are more complicated than usual, it might take a little more time for investors to sort of digest them and react. But the first blush reaction, very slightly positive here on these numbers. So that's what we've got thus far. Joe Brusuelas of RSM is still with me here. Also joining us, Ed Al-Husseini, Columbia Threadneedle Global Rate Strategist, and Peter Tchir, Academy Securities Head of Macro Strategy. Guys, thanks so much for being here. Joe, I'm going to go to you first. We were just talking about what we could expect here. As you said, revisions lower for August and September. That big drop in October. What do you make of all of this?
Okay, well, we got to look at the composition, but
Yeah.
my sense is that's going to be about the Elon Musk Doge era government layoffs. So we'll want to look at the private payrolls numbers in that month once we get that data up. But what I'm seeing here is the 3-month average is now 22,000. That's well below what I think is the 50,000 break even, and slowing wage growth probably reflects some of the sour holiday spending sales that we're observing. My sense is this will tend to reaffirm those at the Federal Reserve who wanted to make the rate cut here in December. Now, my sense is that we're looking at this other data that's coming in, and you saw retail sales stagnated on declining motor vehicle purchases. So I think the totality of it, at least at first cut, before we can really dig in, it's a bit weak today.
Yeah, and so as you mentioned, we got those retail sales numbers as well, and those coming in, as you mentioned, weaker than estimated, month over month in October, flat. Again, this is October numbers, so a little bit backward looking, if you will, excluding autos, up 0.4%. So as you talked about, auto sales contributing somewhat to that. Ed, I'm going to send it over to you here. How do you read this jobs report, and what is this going to mean for the rates market?
Yeah, absolutely. So if I was to boil it down to one number, it's that November unemployment rate, and the 4.6. Not only is it going to reaffirm that making a move in December, that cut in December was appropriate, but it's going to open up January now for us. The odds of a January cut were roughly 1 in 4 going into this, and I think they're going to have to tick up.
Really? You think that number is enough to make more of a case for the Fed to be able to cut again in January?
I think that's right. Unemployment exhibits this really unfortunate dynamic in which it increases slowly and then rapidly. You don't want to get to the rapidly portion. And so from the Fed's perspective, front running that, putting an additional, some additional amount of easing into the system to reduce the odds that, we end up in a bad place with respect to the labor market makes a lot more sense after this labor print than it did even a couple weeks ago.
Peter, what's your take on all of this?
One, I agree that we're probably going to get more rate cuts early next year. I think the one positive thing here is labor force participation ticked up a little bit. So people are trying to come back to the workforce. That did put some pressure on the unemployment. Though having said that, my favorite data point for the last few weeks has been the JOLTS quits rate. To me, that's the closest we get to something that's kind of crowdsourced, right? People know they can quit comfortably and get a new job. That's when they quit. We're not seeing that. It's at the lowest levels it's been since 2014 outside of COVID. So there is something I think wrong in the labor market, and this data continues to highlight that. And I expect a lot of companies are not budgeting to hire a lot next year. So this is going to continue. So I think there's going to be weakness in the labor market going forward, and the Fed's going to be forced to cut sooner than people are currently pricing in.
Joe, you are digging through this report to find the numbers that you need, and you found the number on government cuts.
On the government hiring in October, there was down 157,000. That's a lagged reaction to what happened early in the Trump administration. So you want to exclude that from your assessment of this report, because when I took that out and I looked at total private hiring over the past 3 months, the average is actually 75,000. So as we begin to look at the composition here, I'm going to take the other side of Pete's bet here. And it looks to me like private sector is continuing to hire. My sense also is we get those tax cuts, you get that full expensing, you're going to see hiring stabilize early next year, and we're going to continue to hire, not at big numbers, but enough to keep the labor market stable.
Okay, just to put a pin in that for a minute, just to make clear to folks who are watching right now, when you talk about 157,000
that's right.
government jobs being eliminated, and you talk about this is a legacy of what happened, this is because when Elon Musk came in with his Doge and offered people buyouts,
They took them.
They took them, but they did not go off the government rolls until
6 months later.
6 months later, so October.
4th month to 10th month, and that's why it happened right in October.
Gotcha.
So you can see that here. Now, there are some weak spots here. Leisure and hospitality hiring, which you would have thought would happen in November, didn't happen. It actually fell. Most of this is really just simply around private education and health services. With a little bit of help in retail trade there, but it's there, it's occurring, but not what you want to see, right? But it's not negative either once you correct for that one-time effect from the Doge layoffs.
Well, and Ed, if you're talking about a cut in January, I mean, we do get another jobs report before the Fed meets again. And so that could show, that A will provide maybe a little clearer picture because this is a noisy report. And it could potentially show more signs of stabilization that wouldn't give the Fed material for a cut.
Yeah, I mean, unfortunately, the data has been murky all year. We've had massive changes in terms of the composition of the labor force, immigration, obviously changes on the government side. But from the Fed's perspective, it's a risk calculus. You're never going to have certainty. Do you want to take the risk that you're in an environment where the labor market is cooling to the point that the unemployment rate's going up? At this point, it has exceeded the Fed's forecast for the end of this year. And the Fed's forecasts for next year are at risk if the unemployment rate continues to increase. Do you want to take that risk? Do you want to kind of take it month by month? Or do you want to take some more preemptive action to put some easing into the economy? With this Fed, I'm going to bet on the latter.
Ed, what about the inflation risk? And is the persistence of sort of higher-ish rates on the 10-year indeed a reflection that the market thinks inflation is sticking around?
Yeah, it's difficult to be sure, but if we look at market measures of inflation, they haven't moved meaningfully higher. That inflation compensation in the bond market has remained relatively low and is in fact at multi-year lows, in part reflecting downward pressure on oil prices. I don't think markets are particularly worried about upside inflation risk. And the Fed is quite explicit in telling us that upside inflation risk is quite manageable relative to what's going on in the labor market at the moment. So put a lot more weight on the labor market in the Fed's thinking process and strategy going into next year.
Peter, I'm looking at futures here. They went up a little bit. Now they're going down a little bit. It seems like as anticipated, maybe there's a little bit of difficulty here in trying to parse this.
Yeah, I think we had an initial reaction where everything looked, Goldilocks, I guess, for lack of a better word. I think the reality is setting in that this number is very hard to decipher. It doesn't tell a huge story. And let's get back to the real issues. What's happening with the AI, the data centers? Is that spend continuing? Is it going to continue to grow? Is that going to be a driving force for stocks and the market? And I think that's the big question mark. And I think you're going to see some selling pressure as people question whether we're able to grow that. And again, I think we're going to have this massive focus on electricity. Electricity is a bottleneck. What we're going to do about that? Can we grow that out? So I feel there's just pressure coming in the markets. And this number, now that we got through the noise, we can focus on that, which is probably one of the big stories coming into next year.
Well, Pete, one of the things that's interesting here is despite a very weak wage growth number, which is almost certainly due to the government data, higher paying jobs in goods producing and construction picked up 19,000 in goods producing, 28,000 in construction.
Well, is construction all data centers?
Well, I'm thinking that's got something to do with it, right? And I mean, there's a financial markets discussion, but then there's a real economy discussion. I was down in New Orleans over Thanksgiving, and we had a chance to talk with some people who work for Entergy. And they got 8 big construction projects just to support the big Meta call center. That's going on all over the country. Right? It is meaningful at a certain point in the real economy when those construction jobs, are helping offset the weakness in the housing sector, right? And so I'm very optimistic around that area, even if perhaps valuations are a little overstated right now.
Right, that's as you said, the economic versus the financial market.
That's right,
discussion.
yeah.
Guys, we're going to talk much more in a few moments, so stick around, but we want to send it over to Jared Blickery for a look at the movers on what we're seeing in the markets on the back of this report. Jared?
Well, thank you, Julie. We were down in stock futures when the report was released, and it looks like we're still down. Here's the Dow futures, down 12 points, almost break even there. Here's the NASDAQ 100 futures, down about 0.2%, just 42 points. S&P futures briefly flirting with positive territory, but still tracking a little bit negative right now. So we're going to call that a very, very small muted reaction. And let's check out what's going on in the bond market. Now, these are 2-year U.S. Treasury note futures, and these are the bond prices. So they move opposite the yield. That means that spike up there means yields are moving down in the 2-year tenor right now. And in the 10-year, we're not seeing much of a reaction at all, although we were down in yields or up in price a little bit just coming into that report. And checking out some of the other markets that I like to track here, gold futures seeing a little bit of a positive reaction to the upside. You can see they were underwater most of the night there. And I'll also take a look at crude oil. Doesn't usually move on the payrolls report, and it looks like that is the case this morning. But nevertheless, crude oil sitting at 4-year lows. So these are really important levels to watch in crude oil throughout the day. And then finally, Bitcoin. Not seeing too much of a reaction here. It had already come into positive territory just prior to the announcement, and it looks like it's holding on to a little bit of gains right there. So let's check out the sector action. And what you see behind me is going to be what happened yesterday when we had tech down 1%, energy down in the second to last place, and healthcare leading. And now I'm going to throw the overnight quotes on, and this is a pre-market. You can see healthcare in the lead, but it's only up about 0.2%. That's the numbers in those little rectangles there. Then after that, utilities still positive, staples, financials, consumer discretionary, but very muted reactions similar to the indices that we were tracking just a minute ago. And then energy for the second day in a row, it's leading to the downside, down about 0.5%. Communication services and tech under pressure. So if we take a look at the mega caps, I'm thinking, yeah, we're going to see a lot of the mega caps under a little bit of pressure here. Not Nvidia, not Amazon. Those are each up about 0.4%, but Apple slightly underwater, Alphabet, Microsoft, Broadcom after that big 2-day slide, that's down about 0.8%. So really not just seeing a couple of pockets of strength in the market right now. And what's going to be really important is that we monitor things into the close today. We already have holiday hours, or at least bankers hours, I think, on the trading desk. And a lot of traders have just taken off for the holidays. So not a lot of liquidity right now, but we'll see what happens into the end of the day.
Yes, we will. Jared, thanks so much. Coming up, we'll have more on the November jobs report, and we'll talk to our panel about 2026 and what they expect there. Stay tuned. A mixed picture for the U.S. economy, according to the latest read on the labor market. Let's turn now to the broader outlook for 2026. Still with me, Joe Brusuelas, RSM chief economist, and Peter Tchir, Academy Securities head of macro strategy. And you guys don't agree on everything, which is nice to actually have a little bit of dispersion of opinion here. And I think we've already gotten a little bit of a teaser of what you guys think for next year. But Peter, I want to start you there because it sounds like you think that more Fed cuts are coming, interest rate cuts are coming. You think that we could see a little more deterioration in the labor market. What does all of that imply then for stocks and what you're doing strategically?
Yes, I think strategically, our main thesis on the positive side is what we're calling ProSec, or production for security. So, and I think this does dovetail a little bit with Joe saying, is that we are going to produce a lot more domestically where there is a national security interest. You saw some of that come out of the national security paper 2 weeks ago. And I think it's going to affect chips. It's going to affect data centers and AI where there's going to be help. It's really going to focus on electricity. I think electricity is becoming a far bigger election issue than the price of oil or gasoline. It's electricity. People are focused on it in and around the data centers, but away from that. And then I think you're also going to see this real focus on the rare earths and critical minerals, not just the, extracted versions, but the processing and refining of them. So that's going to be kind of the growth side of it. I think you're going to see some states embrace deregulation and things that allow those businesses to grow. And I think you're going to see some states fight this. So you're going to see a little bit economy there. Away from that, I think tariffs are finally starting to have a little bit of a bite. I'm not seeing companies being very energetic in their spending and growth forecast for next year. So I think if the AI data center stuff slows, and I expect it to start slowing, you're going to see a drag on the economy. And I think that's what's going to force the Fed's hand. And a lot of these things, especially the tariffs, they take time to play out. We're now probably about $250 billion of tariff revenue collected. That is starting to have a meaningful impact to earnings potential, and it's going to start probably spreading its way to the consumer a little bit. So that's why I'm overall bearish with that ProSec, or production for security, is where I'm trying to invest heavily.
And Joe, on the flip side, you and I were talking during the break, and you are looking at this stimulus that's going to be coming into the economy as a result of the tax cuts. How much is that going to be able to offset some of the risks that Peter's talking about?
Well, you're going to get a pretty big and fresh injection of cash in the first half of 2026. Look, you've got pretty big tax cuts that are tilted towards the upper end households. You've got full retroactive expensing to January 19th of this year, right? You've got deregulation. I mean, I don't know if you guys have noticed, we're kicking the tires and lighting the fires on a pretty big credit expansion, right? Especially in private credit. The banks are going to join the party next year, right? And then you're going to get I think 2 rate cuts next year, right? As we normalize down to 3.50, or excuse me, down to 3%. Mm-hmm. So I'm expecting at least $55 billion, perhaps closer to 60, right away as these tax withholding tables are adjusted. Then closer to 70 billion in corporates. So you're going to get a pretty big injection of cash here.
But how is that cash going to then be dispersed? In other words, by the entities that are getting it? I mean, also, if you say the tax cuts are weighted towards the highest income households, that doesn't help with our K-shaped affordability crisis situation.
That's not going away.
Right?
Yeah.
And do the companies use that cash to hire people, or do they use it to spend more on compute?
Well, they may actually invest in the companies in productivity enhancing investment, which is good for the real economy. The way I look at it is, we've had 3 big shocks this year to the economy. Trade shock, immigration controls, and then the government shutdown. This is 2025 ended up being a lost year. We're going to finish up probably 1 to 1.5% growth year over year. But I think that the dynamic properties inside the tax bill should facilitate 2.3 to 2.5% growth next year. Now, in a $30 trillion economy, that's a big move.
So
right?
I got to bring Peter back on this because, what do you think about the stimulus, the tax stimulus that's going to be coming in, and what effect that could have?
I think it definitely helps. Again, the question is, do companies really have the confidence in this economy to grow and spend on plant, property, equipment? Will they do much? Have they already questioning how much they're spending on AI? Will they take this as a buffer that last year maybe they had to loosen up some of their coffers to fill that? So I see the money coming in. I'm less convinced that drags through, especially to the markets, right? Again, the economy and the markets have diverged a lot, right? This year we had kind of this jobless economy, and yet we had stocks do extremely well, especially since Liberation Day. So I could easily see a bit of a reversal of that, where you see the markets come down a little bit, the markets be a little bit nervous, while maybe the overall economy hums along okay. And I kind of refuse to call it the K-shaped economy. I really think we've shifted into what I call the little I-shaped economy, where you have this little dot that's doing extremely well, and the rest of the economy, the big stick, is kind of okay at best. So I think it's slightly more, isolated who's doing well. So again, I don't know that you see quite as much follow through to the broad economy. I think it will help smaller and mid-sized companies better because they bore the brunt of a lot of the problems this year. But I don't think it's going to be enough to be great for stocks next year. Yeah,
that kind of speaks to the firestorm, I guess, that Mike Green of Simplify ignited when he said the real poverty line for a family of 4 is $140,000, which speaks to the littleness of the I and the bigness of the rest of everybody else potentially. There's one more thing I want to ask you about, Peter, and that is the Bank of America December Fund Manager Survey, which was the most bullish in 3.5 years. And it feels like once again here that we are the vibes are not matching what's happening, right? Like the market, to your point, the market seems great, or the vibes seem great among fund managers, and yet there's this disconnect with how people in the real economy are feeling.
Well, also, that's always the danger, is right? Once everyone's kind of all in, any hiccup results in pretty heavy selling. You saw last week a couple companies, in the tech sector had small misses. You read the report, they didn't seem that bad, and yet the stock was down 10% that day, dragging it down. So I think this is, everyone's kind of all in. Everyone wanted to show they had as much exposure to some of these sectors that had been doing well. So it doesn't take much of a question mark to bring these down. And I think what we're going to see is, at least from some of the tech companies, it's not going to be a full-on debt diet. They're not necessarily going to, cut their spending plans, but I think they're going to have to be much more careful and not say, hey, we're going to spend at all costs. We went through, say, a year ago where if you said you were spending 10 billion, boom, your stock went up 20 billion, roughly, right? So you had almost free money. That has now changed. People are checking that spending. There is concern in the private credit market. There is some concern in the public credit market about the amount of money coming in, not just to fund the data centers and AI, but as Joe pointed out, it's going to be how do we fund the energy production and electricity production more specifically to get those. So I think there's a bunch of headwinds, and that has been such a strong leader that's why I just don't think these markets can really go higher until we see some selling, get people back to maybe a little bit of nervousness.
Joe, Peter, we got to leave it there. We could do this for another hour. Thanks so much for being here. Appreciate it. Stay tuned for Morning Brief. We've got more coverage on the November jobs report and more news. That's next. and Brief presented by Robinhood, the home to commission-free trading. I'm Julie Hyman. Let's get to the three things you need to know today. First up, a mixed picture for the labor market. Delayed jobs data from October coming in far worse than expected. The U.S. economy lost 105,000 jobs that month, with the estimate only forecasting a decline of 25,000. Meanwhile, November data came in above forecast, with 64,000 jobs added last month. Meanwhile, the unemployment rate also ticked up to 4.6% in November, all of this creating a cloudy view for the U.S. economy. And we're seeing that play out in the market. U.S. stock futures initially gained after the report. They've since dipped into the red. That said, we're not seeing dramatic swings. Traders are holding on to bets for 2 interest rate cuts from the Federal Reserve next year. That view at odds with the central bank itself, which forecast only 1 cut for 2026. And Ford is rethinking its electric ambitions. The automaker will take a $20 billion charge tied to a sweeping overhaul of its EV business. Ford is canceling a planned electric F-Series truck, shifting production towards gas and hybrid vehicles, and repurposing an EV battery plant. The company said the majority of those charges will come in the fourth quarter and will make its EV operations profitable by 2029. However, the automaker did boost its 2025 guidance as the company shifted to more profitable vehicles. Let's get a check-in on stock futures here this morning. We are seeing negative indications for the open here that have been deepening a little bit. The Nasdaq right now, 100 is indicating a drop of 0.4% at the open. The S&P 500 showing a drop of about 0.25%, and the Dow about half that. But of course, we've seen a lot of volatility already this morning as investors try to make sense of all of the data that we just got. So let's dig into our top stories of the day. Joining me now, senior reporter Brooke DePalma live at the Nasdaq, Federal Reserve correspondent Jennifer Schonberger, and senior autos reporter Pras Subramanian. Jennifer, let's start with you. On the one hand, this is the 4th straight month that we've seen the unemployment rate tick up. We haven't seen that in years, but these numbers are pretty hard to parse.
Yeah, I just want to say that ordinarily a jump to 4.6% on the unemployment rate would have really caught my attention and the Federal Reserve's attention. But there's a lot of anomalies in this report. For starters, we saw so many government workers roll off the payrolls. For the month of October, 162,000 government jobs rolled off because remember, they took those early resignations. On top of that, 6,000 jobs off in the government sector for November. So 167,000 total for October and November. That alone, I wonder how much of that is pushing up the unemployment rate at a time when labor force participation rate actually inched up as well. And the Labor Department says, look, the standard statistical errors here are much higher because of survey response, because they skipped October. They said they're going from a comparison period of 12 months versus month to month because of they had to skip the October period because of the government shutdown. And so I think that, we heard from Chair Powell, and he said, look, we're going to take a skeptical eye to this data because the shutdown is going to not give us a full, clear picture of the data. And that's exactly what we're seeing this morning. So I don't think this changes the Fed's position at this point. Maybe it gives them some sigh of relief that they did cut last week, but I think we're going to need to see another labor report that's not clouded to the extent that this is before we get a better reading on the job market and for the Fed to move forward at that point.
And Jen, we're going to be getting CPI this week as well. But I mean, again, when you look at these numbers, what do we need to know looking ahead to January and how all of this is going to start to maybe smooth out or become a little more clear?
Yeah, so we need to see if this weakening trend continues in unemployment, because if it does, then that's going to bring inflation down. If this is an anomaly and we do see, it swing back up, then, maybe that has other implications for inflation. The fact that the labor force participation rate inched up 0.1% indicates to me that there's not as much weakness, perhaps, in the labor market than these numbers would put on, which would mean that you would have a bit of inflationary pressure at that point. And we heard from New York Fed President John Williams yesterday, and he's forecasting a very strong economy for next year. So we have to see how demand responds, though he sees inflation starting to come down to 2.5% next year, as he thinks those effects from the tariffs have already been factored in the first half of the year. So we're really going to have to see how things actually play out here, and whether companies end up passing on costs to consumers, whether consumer spending remains strong, and really what happens with the job market.
And the market is trying to make sense of all of this. In the meantime, Brooke, we're seeing stocks kind of initially went higher. Now we're seeing them go a little lower. What stands out to you?
If you take a look right now, we're back in the red this morning after seeing that momentum in futures trading this morning, slowly making our way into the green, now reversing that course. We do have the NASDAQ leading the downward momentum, down about 0.3%, slightly off of the low lows that we saw earlier. The Dow also down about 0.1%, and the S&P 500 down about 0.2%. But moving into this report, investors are largely trying to make sense of it all and what exactly this does in turn mean for the Fed. Now, keep in mind, at the same exact time, the unemployment rate, that's the highest that we've seen since 2021. It's now at 4.6%. Also heading into this, there also have been concerns around that AI trade, particularly around CoreWeave. I know we'll chat more about that later on in the show. And so investors really trying to parse through as we make our way towards the end of the year on what exactly this all means for the AI trade, for the Federal Reserve, and also for other implications as we move into next year, when we are going to get, as Joe Brusuelas mentioned, those bigger tax refunds, especially for high-income earners.
And Brooke, by the way, we didn't just get the jobs report. We also got some October retail sales data.
We sure did, Julie. So much data out this morning, and those retail sales, what they showed us was that they were actually unchanged. Economists had forecasted about a 0.1% gain in retail sales, but for the overall aspect of retail sales, there was no change. But however, if you take that on the flip side and you look at it excluding motor vehicles and auto parts, there was actually a 0.4% gain, and that was higher than what the street had expected of a 0.2% jump, as you can see on your screen. And motor vehicle and parts dealers, as part of how the retail sales are broken out, that saw a decline of 1.6% in the month of October. Other areas that also saw a decline in labor sales include other areas that we've really heard of consumers pull back on, one of those being building materials. We know, based on what we're hearing from retailers like Lowe's and Home Depot's, consumers are pulling back on home renovations. Also, food services and drinking places, those also saw a decline in the month of October as well. So perhaps consumers being choiceful about where they're spending. Things that offset those declines, though, worth noting: furniture and home furniture stores, food and grocery stores, as well as sporting goods stores and general merchandise stores. So definitely an environment where consumers are pulling back a bit, being more choiceful. And Moody's rating even out with a survey this morning saying that heading into 2026, this is how they expect things to go. Consumers are still going to show up, they're still going to spend, but they do expect a bit of a slowdown compared to what we've seen in past.
And another big story that we're following this morning is Ford really scaling back its EV ambitions. I mean, Pras, this has been such an interesting year for electric vehicles. Talk to us about what Ford is doing here.
You know, we've been seeing hints of automakers making their changes to their EV strategies, in particular companies like GM and Ford that invested heavily in that transformation. And so a big Ford pivot here, right? So they're going to make more gas-powered trucks, converting some EV plants to truck plants. The Lightning EV pickup is done. It's going to be canceled, eventually replaced with an E-Rev, which is basically an electric vehicle that uses an onboard gas engine to charge the battery. So that's going to be a big change there. And Ford says, like, more hybrids and these E-Revs are coming. And then, of course, they've actually introduced a battery storage business where they're actually going to take some of these plants that are making batteries for EVs and convert them for data center use, grid scale operators, right, utilities, to sort of reuse some of that capacity they made in these battery plants. Now, this is all going to cost Ford a lot of money, you know, as we're seeing a $19.5 billion charge in special items, with the majority recognized in the fourth quarter of $12.5 billion, and the balance $7 billion being hit in 26 and 27. So it's not going to hit their actual adjusted earnings, but you're going to see those on the special items there. Inclusive of that is $5.5 billion in cash charges there due to vehicle cancellations and charges, and another $8 billion in write down on EV assets. So that's just a lot going on, a huge hit there. But we knew this was coming for Ford, and they had to sort of adjust their path.
I'm curious, you know, if you are one of those people who got a Ford Lightning, like, do you feel sort of stranded? Like, what happens in those cases in terms of servicing or whatever?
I mean, Ford is going to, the vehicles are warranted. The company's not going to go away, right? So these vehicles will be serviced. They'll have parts available. They will have to support that vehicle for many years, right? So that's not a problem. I think if you're a Lightning owner, frankly, you got a good deal. You bought a car that Ford was spending so much money to develop. They sold those cars at a heavy loss. So that's good for the consumer, not good for Ford and shareholders. So that's why we're seeing that pivot. So you shouldn't be worried about that. I think the big question is, what are the next generation of Ford EVs going to look like? They still are going to make EVs, and they're going to use this universal EV platform to make smaller, mid-sized type vehicles that they think that a broader market of Americans will want to buy.
I mean, that's really the big question. And this is something, by the way, on Thursday, we're going to speak with an analyst more about the just broader outlook for EVs. But Pras, I'll ask your take as well. Like, this has been a year of fundamental change, as I mentioned, for EVs and the pivoting of the market in different and sort of unexpected ways. What's sort of your big takeaway from the year in terms of what changed for that market?
You know, the loss of that tax credit is what's really hurting the consumer adoption here. You know, we expected EV sort of penetration to go above 10% this year. That's probably not going to happen because of the loss of that tax credit. In places like California, you're above 25, right? In New York, probably in the teens too. So that's pretty good, but it's just that middle of the country adoption is going to be slow. But I think what's going to happen, Julie, in 2026 and beyond is traditional automakers are going to figure out a way to make cheaper EVs that are actually going to be cost efficient. And they think that Americans will buy a car if it's efficient, if it costs a decent price, and can get them from A to B cheaply. And EVs let's be honest, are the best vehicle in terms of form factor, in terms of cheapness for operating. So I think you're going to eventually see sort of like a revolution there in how these cars are made, and they're made cheaper and probably smaller. And that's where we're going to go with EVs, I think.
I'm really curious to see how it all plays out. Thanks so much, guys. Brooke, Jennifer, and Pras. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. Welcome back to Morning Brief, presented by Robinhood. Now time for some of today's trending tickers. We are watching Pfizer, Kraft Heinz, and PayPal. First up is Pfizer. It's out with its 2026 guidance. The company expects little to no sales growth amid the loss of exclusivity on some older drugs. It also expects revenue from COVID-19 products to be $1.5 billion lower than what it had previously expected. Pfizer's seen declining demand for its COVID products in the years following the peak of the pandemic. That has it pushing into emerging areas like weight loss drugs with its recent acquisition of Metsera. All of that said, its range for revenue for next year, the midpoint of that pretty much in line with what analysts had been anticipating. The shares little changed. Next up, Kraft Heinz. The company has tapped the former Kellanova CEO to lead the company ahead of its planned split next year. The new CEO will join next month and will serve as the CEO of the business it's calling Global Taste Elevation. That includes high-growth brands like Heinz, Philadelphia, and Kraft Mac and Cheese. The Kraft Heinz board will initiate a search for a CEO to lead the portfolio of grocery staples, which includes brands like Oscar Mayer and Kraft Singles. The split next year will reverse its 2015 mega merger, which was orchestrated by billionaire investor Warren Buffett. Finally, PayPal. The fintech firm has applied for a U.S. banking charter. That move coming at a time when bank regulation has been relaxed under the Trump administration. If approved, PayPal Bank would help the firm bolster its small business lending capabilities. The application comes on the heels of a number of crypto firms securing preliminary approval to become banks last week. An uneven labor market and AI bubble concerns may be casting a shadow over the markets, but fund managers see light on the horizon, and they're the most bullish they've been in 3.5 years. That's according to the latest fund manager survey from Bank of America. For more analysis of the markets, I'm joined by Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities, joining me here in the studio. So it is interesting that we have this sort of like disconnect between investor sentiment, which, as I mentioned, according to Bank of America, is very bullish, consumer sentiment, not great. You know, the market's good, the broader economy, depending on who you're talking about, not as good. Like, how do you put all of that together?
Yeah, I guess there are a few disconnects in a mixed bag. If we look overall at sentiment, that's when we assess the market, we look at fundamentals, valuation, and technicals. The sentiment actually has come off overall. Now, you cite a survey, amongst fund managers, but if you look at Investors Intelligence and the AAI data, it actually was super bullish, which was a concern, and it's backed off a little bit into kind of neutral territory. But this dichotomy that you're talking about, I think, is representative of what's going on. The affluent consumer, and I think fund managers probably fall into that category. They're great, right? Record high in stocks. We got plenty of home equity. We're employed, and things are going pretty well. And you would like to see a more equitable distribution of wealth, right? That's exactly what we'd like to see, but that doesn't mean that it can't push stocks, the affluent, couple that with capital spending, that can't just push the economy and earnings and the market. And I think that's where we're at.
Let's talk about jobs as well, because obviously we got a jobs report this morning that was a very noisy one, but we did see the unemployment rate ticking up for the fourth straight month to 4.6%. You saw those DOGE cuts in the government take effect, so a big drop in government employment, but a 64,000 person gain on the rolls in November. So what does that tell you about the job market, or is it still kind of confusing?
Well, I think the Fed reporter that you had just a few minutes ago assessed what's going on. Spot on, absolutely. And like everything else, this is a mosaic. There's not one number. And so not only is that 4.6% unemployment rate that was a bit of a spike, a couple ticks up, influenced by these temporary factors that she pointed out, the government layoffs, an increase in labor force participation rate, and it's just kind of noisy. If you look at things like real wage growth, unemployment claims, new unemployment claims, and just broader factors, just like in 2022 when everyone said, oh, we're going to go into a recession because we have an inverted yield curve. I don't think so. You got to take a look at the credit markets and just broader data that give you a mosaic. And I think overall, we should expect for structural reasons, slowdown and growth in payrolls, but that doesn't mean we can't pay these people and that productivity won't go up, that unit labor costs won't go down and profit margins go up. And I think that's what's going on overall.
Okay, and so what does that mean then for the market in terms of where you want to put your money? Do you want to try and find those companies with that, with the expanding profit margins?
I think you do, and our theme this year, which we could almost make it the theme next year, was clear air turbulence. Good returns. We're going to have accelerated growth next year because we're going to get massive tax refunds, capital spending is going to continue, and productivity is going up. But I think, like as your one guest talked about the I economy, where it's been really concentrated, one of the good things that we've seen over the last month has been this broadening.
Well, in the market, not necessarily in the economy.
No,
maybe.
no, not. But you
in the market for sure.
In the market, so that's what we're positioning for, and it's been the financials, it's been healthcare, industrials, and pockets of consumer. So as you see, Mag 7, which was all the growth. And you had the impressive 493, as Yardeni likes to talk about. They still have some pretty good return numbers and earnings growth numbers and nice valuation. That gap, Mag 7 versus them, is going to shrink. And they're going up. Mag 7's coming in a little bit. I think our theme next year is diversification 2.0 and risk awareness.
Okay.
Be balanced.
Into what?
Into these
Like,
areas.
what's going to shrink the gap the most? What's going to...
Well, I do think in a steepening yield curve, regional banks haven't participated. It's all been asset gatherers and the investment banks that have performed really well. I think you have specialty situations, a higher beta name like a Robinhood, I think, with the prediction markets and just their overall platform will look well. I think healthcare, particularly biotech, looks really good. Things like Regeneron, I think, provide great opportunity. And then within industrials, it's interesting to see the transports pick up. We've got plenty of industrials tethered to the AI trade, like GE Vernova, but you're starting to see the transports tick up. And within materials, commodities, we're seeing growth and strength in commodities. So I think domestically, I would be asking the question within tech, if you're kind of worried about what's going on in tech, it's been all semis and hardware and hyperscalers. ServiceNows, haven't participated. Salesforces, they will. So maybe you might want to, kind of balance that out just a little bit as well. So,
Jeff, thanks so much for coming in. Good to see you in person.
Thanks for having me.
Coming up on Yahoo Finance opening bid, our executive editor Brian Sozzi is with us now. Soz, what's coming up?
Hey, Julie. I'm already over the jobs numbers. I will mention it. We'll dissect it a little bit, but I'm more focused on the sell-off, these sell-offs in CoreWeave, in Oracle, Tesla trading near record, and Julie, as you know, or maybe you don't know, I'm a big Landman fan, watching that show every week, so it's no small surprise the CFO of Phillips 66, giant oil driller, is going to come at our headquarters and talk about the future of that company.
I'm not sure I did know that. I know you're not a big fiction TV watcher, you're a docu-series guy.
I'm more of a documentary type of dude. I try not to watch a lot of TV, only I watch old clips of you, Julie, on Yahoo Finance.
Of course, but it doesn't surprise me at all that you're a Landman guy, I should say.
Great show.
All right, that's us for Morning Brief, presented by Robinhood. Saz has got you next.